Good afternoon, everyone, and welcome to our session. The Broadband Bunch Zero Touch Learning Series is now live. Thank you so much for joining us. I am Heather Gold, and today's session is entitled Broadband Funding Options and Potential Pitfalls. The Broadband Bunch podcast and Zero Touch Learning is brought to you, as always, by our Zero Touch Automation Experts ETI software solution, along with our partners, Utopia Fiber, DXTEL, Calix, and ITK Solutions. Be sure to follow the Broadband Bunch on Facebook, Instagram, and Twitter. And you can also access Broadband Bunch podcasts on your favorite podcast players such as Spotify, Google Podcasts, SoundCloud, Apple Podcasts, and more. A quick reminder before we start our session today. We are being pre-recorded and it will be available to all attendees and future guests for access. And please feel free to submit additional topics for potential series and/or panelists to us through our LinkedIn page. And thanks in advance for listening in. Now I'd like to introduce our topic and our guest. In this discussion, we will explore funding for broadband expansion on a strategic level. Instead of a laundry list of federal, state, and local grant opportunities that are flooding the market today, we are looking primarily at the array of debt that is available either through government agencies, semi-private or fully private sources, as well as any equity potentials. Many times, providers will decide to use these options in conjunction with public grants in order to better leverage their options and cash flow. Today, we will discuss some of the hidden costs and potential pitfalls that should be on your radar as you examine these options. We are pleased to be joined by Marty Fredericks, CPA and partner of BKD CPAs and Advisors, an expert with strong financial accounting background, having worked with many rural providers on exactly these issues. In his role, Marty provides audit, tax, and consulting services to a variety of telecommunications, cable television, and wireless provider entities. He also assists with financial reporting, mergers, acquisitions, and budgeting. He co-manages BKD's annual telecommunications client link benchmarking study and an annual telecommunications accounting seminar. And with that, welcome, Marty.
Thank you. Thanks for having me.
So let's start off, Marty, by exploring some of the trends you have seen in the industry that may raise alarm bells about some telecom companies' review of accounting pitfalls.
Sure. I want to start out by saying I've been an auditor for 25 years, auditing various communication companies. And, we've had a decent percentage throughout that time that have had some debt. And I want to point out, as we start out today, saying, there's an old saying that goes, not all debt is bad debt. I know we get in this philosophy saying, boy, we can't borrow money, we can't be in debt. But there's oftentimes that having some debt is a good thing and can be financially beneficial to a company depending on the interest rate. And when I say that, depending on the interest rate, if you can borrow at 3%, as an interest rate, but you can get a return on your cash and investments that's 5%, you're better off. You're better off borrowing money if you can get some low interest loans. And whether you're investing cash in the stock market or in equities or mutual funds, often you can get a better return than that. So that's why I mean that not all debt is bad. When I started in 1996, we still had a decent amount of our telecommunication and our rural telecommunication clients that had what I like to call old debt or old RUS money that they had drawn out years ago to first, move their facilities to copper-based facilities. A lot of that old RUS debt was 2% money. It's 2% interest on that debt. And this was a time, and I know it seems like a long time ago, but in 1996, we had many clients that could go and get a 2-year CD at 5%. So right then and there, it made no reason to pay off this old 2% debt when you could get 5% earnings on a CD in a local bank. The slide that you currently see on your screen kind of emphasizes my point a little bit here. In the benchmarking study that Heather mentioned, we've been analyzing this data for many years, and you can see on this slide the second bullet point there. In 2001, we had about 79% of our rural telecommunication companies that had some sort of debt. And I want to tell you, a good piece of that 79% was 2% RUS money. Fast forward 20 years, and we go from having 79% of our clientele in rural telecommunications to 54%. So what happens? Why did that number drop so much? Well, what we've seen over that time, a lot of that 2% money has got paid off. What else has happened? The interest rates on borrowing has stayed in the 3, 4, 5%, but the interest you can get on your money has gone down. Unless you're willing to take some risk in equities in the market, you're not going to get that. You show me where you can get a 5% return on the CD right now, and I'll go invest a lot of money at it. It's not happening anymore. So what has happened over that time? A lot of those clients, since they couldn't get a good return on their money, paid off their debt. And that's why we went from 79% of our clientele with debt to 54%, because there wasn't that old low interest rate money anymore. Now, I know you kind of asked me, Heather, about some pitfalls. I just wanted to set the stage a little bit to say that we have seen some of that old debt get paid off because it was lower interest rate. Now, pitfalls, one that I often see is borrowing too early. And you don't want to start paying interest on the money and having an interest expense if you don't need the money yet. So that's one thing I advise people to look at. Don't start pulling down funds from whatever lending institution you're going with until you actually do need the money. We see clients for the first time that have borrowed money that the lender requires an audit. And we have certain clients that never had a full financial statement audit before. That's the highest level of service that a CPA firm can offer, is full audit services, and audits are way more detailed, way more time consuming, and in the end, way more costly to the company if an audit is required as compared to a compilation or a review. So that's one thing that maybe they haven't had in the past, having to do an audit for the first time, they weren't aware of it, and they have to be ready with their internal controls and documentation of all the different things that an audit requires. Another pitfall we've seen people run into, Heather, is a good work order system. Now, most of the time when companies are borrowing long-term funds, they're going to build out construction. They're building out fiber. They're having long periods of construction. And with that, not all that construction is done immediately. So you need a good work order system to track that. And we have clients that haven't borrowed a lot of money and gone through the real long-term construction that don't have a really good work order system to account for and to track all this construction that's being done. So that's another type of pitfall we run into. Capitalized interest. I could spend a whole presentation talking about capitalized interest. I bore a lot of people, but I'll put it this way. If you're going to borrow quite a bit of money, you're going to have a lot of interest expense, and you're going to have a construction period, odds are you're going to have some capitalized interest. And that's one thing that many companies got to learn to account for the first time, because they've never had to do it before, and they've never had to calculate how much interest that should be capitalized. That's another pitfall. One last one I got here that I can kind of think of is, the different lenders require different times the financial statements can get turned in. We had a few clients that they were required to have an annual audit, but their annual meeting of shareholders maybe wasn't till April. So their audit report never had to get issued in the past till April. But then they go and borrow from somebody, and that lending institution wants the financial statements due March 31st. So now all of a sudden, the audit's got to get done a little bit sooner. The report's got to get issued a little bit quicker because the lending institution wants the report before it ever was. So I could go on, but those are some of the ones that I've seen recently as pitfalls.
So even though it looks like as an industry that there's a long-term trend towards improved balance sheets, the actual debt that's on this balance sheet may not be as favorable as it was before. Is that what you're saying, Marty? It
Yeah,
might be at a higher interest rate. It might be from a different mix of lenders. Um, and that's why it's so important to work with your accountant if and when you decide to get this debt. Is that basically what I'm hearing you say?
yeah. I mean, the total number of companies with debt has gone down. I know you're trying to analyze, how much of the balance sheet is based upon debt and how much is based upon equity. Well, what we've seen the last couple of years, and when I say last couple, that's 2 or 3, is we've seen some more companies get into borrowing and some more companies that have never borrowed before. And so there's an uptick in that, and a lot of it has to do with, yes, they are getting all the various funding ways out there, whether it be grant money, RDOF money, ACAM money, all the different areas to get some funds. But they start construction, they need money up front. They need money before those come in. I think if you advance to my next slide, you can see a pretty good trend here. And it goes to your point a little bit, Heather. If you look at 2001, and what this slide is showing you, it's total equity as a percentage of total assets for the rural communication providers that we work with. Well, in 2001, equity was 60% of assets. So in theory, those companies were financed 40% with debt. Now, when you go forward to 2020, you see that's only 82%. So what has happened is the companies as a whole are being less financed with debt, and there's more and more equity there. One thing I really like to point out is when you go from 2019 to 2020, when it goes from 84% down to 82.6%, that's due to a lot of the borrowing we saw in 2019 and 2020. We really saw an uptick in borrowing during that time. So that means it's a little more financed with debt as compared to equity. And that's the numbers point out the trend is less and less debt all the time, but you do see that go back down with borrowing later in that period.
So Marty, when will internal sources generally suffice over the life of the build, or when should a company decide to go with external funding sources?
Yeah, I usually think it's before a big build. And one thing, on the next slide points out something that's pretty interesting with that. The slide before, you saw the amount of the balance sheets being funded with debt go down. The percentage went down. There's more and more equity and less debt on the books. Well, during that same time, Heather, if you look from 2011 all the way through 2020, what this slide is showing you is there was still a lot of construction. You didn't see a lot more borrowing, but you still saw a lot of construction. This is gross plant per access line. Those balances kept going up and up and up. I mean, people were investing in their plant. What were they investing? Their operating cash flows. Their operating cash flows were funding a lot of their construction during this time. Now, you look at those last few years there, 2018, 2019, and 20, you see some pretty big jumps. Well, those pretty big jumps are when people kind of started getting back in and borrowing once again. So, when we see that big borrowing that's needed, it's when the beginning of builds start, whether it's an ACAM, RDOF, whatever grant funding that's coming in the door. It takes some time for that money to get in the door. So why do we see borrowing early on is, companies are having costs before they've got the money. They're having engineers design the network. They're having contractors go out and stake the network. They're having people like myself and other consultants running financial numbers to make sure that the borrowing makes sense, to make sure the business model makes sense. So there's consulting costs. Add to that, now the supply chain has slowed this down a little bit, but usually they were out there buying a bunch of fiber as well. They needed money to buy the fiber. So it was there once the engineering was done and the contractors were ready to go. So usually that's when you're seeing a lot of the borrowing is early on in the projects with the whole idea that's going to produce strong cash flows. You get that facilities out there, you get the plant done, you're going to increase your revenues during that time, and you're going to increase your cash flows. So in the back end, you can kind of pay off that debt. And with the whole thoughts that that debt may not go the whole 15 or 20 years that you have it borrowed for, that you were trying to pay it off before that with the operating cash flow.
In general, based on these improving funding internally, will internal sources generally suffice over the life of a build? In other words, when do you need external sources?
Yeah, usually what we've seen, Heather, is the needs at the beginning of a big build. Often we see rural providers that they've been awarded ACAMs or RDOF funding or grant funding, but it usually hasn't come in the door yet. But they're already starting to have expenses, meaning they've had engineers that are designing the build out, or they've had contractors that have gone out and already started staking the build. They've had expenses with professionals like myself and others that are building projections or analyzing different loan documents. So they're starting to have some upfront costs before that money comes in. So that's often where we see the borrowing, and the biggest majority of the borrowing take place is on the front end of the construction, pay for some of these costs. Then you start getting the support that you've applied for. And when that support starts coming in, that helps to pay off some of that debt on the back end. So you're getting that cash flows from building out that construction in addition to the funding that you're getting, and that can take care of the financing the debt after that build is done.
So there really is a strategic value in getting external funding.
Sure there is, and I still always go back to the interest rate. If you can't get a reasonable interest rate, there may not be a reason to do it. But we're currently still in a pretty low state of interest rates, and we've all heard that the Fed's probably going to raise some interest rates. So guess what? They may be going up. If I was contemplating about borrowing right now, I'd probably think about doing it sooner rather than later, because you might lose some interest points as you go down on the line. But I think of the partnerships that can be developed too with borrowing. I look at clients that borrow from a local bank, and the local bank really wants them to borrow local. They really want those funds available locally and to help out the pursuit of building broadband in their area. So then they really partner with the communication company, and they go out and say, guess what? We partnered with XYZ communication companies. We've loaned them money, and you get it out there and you get customers aware of that partnership, and really brings a good sense to the community and helps grow both the bank's business and the communication company's business. But on the flip side of that too, a little bit, another reason we've seen for real strategic borrowing is when companies look to expand. We've got clients that maybe have never borrowed before, but guess what? There becomes an opportunity to buy a company close to them, or there becomes an opportunity to buy a neighboring exchange, a neighboring community, and their current operating cash flows, there's enough there to go out and buy this additional plant, this additional company, these additional customers. And so then, that's a time that comes along where they do go ahead and they borrow funds to be able to do that. So that's another real strategic reason for borrowing, not as much to build out their historic areas, but to be able to expand their base and their customer base.
So if you're looking to borrow, I guess there are two sort of strategic questions beyond the ones you've laid out, additional, like when do you time it and who can help you ascertain that timing? I mean, we've talked about supply chain issues and what that's doing to build timing, and so what trusted partner do you to go to for that? And then the second thing would be, what are the considerations companies should look at in terms of who they borrow from?
Sure. So, the timing, as you mentioned, is very important. And my joke is always, don't borrow until you need it. That used to be pretty simple. You kind of plan out your construction in phases and know when the big invoices are going to be coming in and when you need funding. That is not as easy as it used to be, because you mentioned the supply chain issue. Now, one thing that we've been seeing a lot of clients do, Heather, that can help that issue is is taking out lines of credit. Maybe, you're going to have some long-term debt at some point in this borrowing situation, but you might, get a line of credit for $1 million to start, or you don't know when you're going to pull on that line because you don't know when you're going to get the fiber in. You don't know when some of those things are going to happen. So you get a line to help pay for that, and then once you get the construction going and all the materials are there, and you're going to need some longer amounts, that's when you go ahead and do the borrowing. But it really has become more difficult than it used to be to know the right time to borrow, and like you mentioned a little bit, the right type of borrowing. Is it a long-term fixed 15-year fixed, or is it a 20-year variable as compared to, hey, we could get this done just with a line of credit. We're only gonna need a little bit of money for the first year or two. We don't need to have a long-term debt to pay off. So there's a lot of things to think about that, and both the banking and your CPA firm could help you analyze that. But usually a lot of times it takes what the engineers and the contractors say. What is the plan for this build? When do you think some of the bigger dollar amounts are going to be needed? And then your financing people can help you analyze when the money needs to come in.
Okay. And again, what should you be looking at in terms of who you go to borrow the money?
Yeah, there's a lot of different lending institutions out there. There's ones that specifically are in the industry. RUS, CoBank, RTFC are ones we often work with. But we also look at some local banks as well. And I'm always going to go back to the first thing you look at is what is the interest rate? That's the number one thing to go with. But that isn't the end all be all either, Heather, because sometimes you might have a lower interest rate, but maybe that lower interest rate comes with early payment penalties. I was talking about some of these companies that are looking at not going a full 15 years on this debt. They plan to get it paid off in years 7, 8, or 9. Well, does a lower interest rate say if you pay it off early, you're going to have some penalties? So that's one thing to look into when you're comparing lenders. The term, as I mentioned, I might get a lower interest rate, but it's for 20 years and I can't pay it off early without penalties. So what's the good of a lower interest rate if you're going to pay interest for longer than what you planned on? So that's the term is another thing to keep track of. I mentioned the audit requirement. Maybe one lender requires an audit and the other one doesn't. Well, if your audit fees are going to be 10 to 15 grand more than review fees, and you're only going to save 5 to 10 grand on interest a year, then you just lost. You're losing money by doing that, because you're going to pay more in interest expense than you are in audit fees, or vice versa. So that's another thing to keep track of. Monthly or quarterly reporting. Some lending institutions just require an annual financial statement. That's all you have to do. Give us an annual financial statement. Where other lending institutions require monthly financial statements. You got to give that institution each month how it's going, or quarterly. So there's some more reporting requirements there. And kind of the final one, I prepared a couple slides on this too, are lender-specific loan covenants. And I think the next slide that we have kind of points out some key lender loan covenants, and these are just some of the ones I put together, Heather. They can vary by institution. They're not all, hey, every single loan you're going to walk into are going to have these loan covenants, but you need to be aware of what the institution you're borrowing from, what their loan covenants are. The first bullet point there talks about the current ratio. That's current assets to current liabilities. And what I encourage any of your viewers of this webcast to look at is go and calculate these ratios as they are today. Know what they are, and if you're passing them with your current financial statements. But then the next big key is, okay, when we borrow, how much can we borrow, and how much will our borrowing change these ratios? But you do see the current ratio first. That's one that many lenders look at. I'll tell you another lending joke. When someone says, "Well, Marty, what's the best way to borrow money?" I go, "Well, have a lot of cash." It's like it seems pretty simple and kind of a joke, but it is the truth. The more cash you have, the more you'll be able to borrow, because guess what? Those lenders can get that quickly. Then the next question would be, well, why borrow money, Marty, if we have cash? And I'll go back to my point earlier. Well, if you can borrow at 2% and you can invest that cash at 5%, Why in the hell wouldn't you, borrow some at a lower interest rate than
Right.
you could earn at? You look at these slides here. Current assets, current liabilities is that first one. I put our benchmarking study out there. I want to point out a few things in our benchmarking study. You see that of our 170 rural companies we put together, 5.26. So your current assets were a little bit 5 times more than your current liabilities. But a typical lender requirement is only 1.5. A good number a lot of times is 3. And you might say, well, why is your benchmark so much higher? Well, it's slowly going down a little bit, or leveling off as we see people borrow more money. And I think a slide later will show that a little bit. But that's one to count, to look at. The times interest earned, our benchmarking study. And first off, I should say what EBITDA stands for: earnings before interest, tax, depreciation, and amortization. That's basically free cash flow. What is your cash flow divided by your interest expense? Well, the BKD benchmark study is 14.97, which is way higher than the next bullet point there of 1.5. Now, the reason that 1.5 has an asterisk by it is that's an RUS calculation, and tier is a big calculation that RUS looks at, and they don't calculate the tier the way it's defined there and the way it's defined if you go out and Google tier. The way they calculate it is you get to add back the interest from your earnings, but you don't add back the taxes, depreciation, and amortization. So you think about it, the amount you're dividing interest expense into is a lot smaller amount under that scenario. You're not, that EBITDA number is way higher if you get to add back taxes, depreciation, and amortization. So that's why their calculation is lower, and to realize you don't get to add back taxes, depreciation, amortization under that one. The final one there that is always important to check each lender is debt service coverage. So now you're taking your operating income and you're dividing that by the principal payments and interest payments. Same thing. How much of our operating income can go towards servicing our debt? In this scenario, it's not just the interest payments like the tier is; it's the principal payments as well. Our benchmark study said 5.64. Typical lender requirements, the same thing. Are you generating enough cash, enough income to be able to pay off your debt? That's what all these loan covenants kind of look at. Go to the next slide. There's a couple more there. The leverage ratio, same thing. This is a little bit opposite. You want a low number here because it's basically taking your total debt and dividing it by that EBITDA. You want a lower number there, basically saying you don't want to borrow way too much that you're never going to be able to pay it back with your cash flow, and that's what that's kind of determining. And the final one there is fixed charge coverage. That's another one that companies look at. What that's trying to do is it's taking that earnings before all those items, but you also take out gains. Sometimes that earnings, bottom line earnings, you're adding back the interest, the tax, depreciation, and amortization, but that's not adding back any gains or one-time gains or sales of investments or sales of equipment that does go in the bottom line income. That one takes that out as well and puts it on the current debt. So, there are a lot of loan covenants there. The next slide, as I mentioned, you kind of look at that current ratio trend. And when you look from, you can see some 17, 18, and 19, dividing current assets into current liabilities. That slowly was going up, meaning balance sheets were becoming stronger, less financed on debt, more equity there. But then you see that downtick from 2019 to 2020, going from 6.02 to 5.26, and it really points out what we talked about, Heather. There was a lot of borrowing in 2019 and in 2020. So when there's a lot of borrowing during that time, some of that's going to be current debt. At some point, you're going to have to pay that principal. And in 2020, some of that debt became current. I mean, it's going to be, you have to get paid within the next year, and that's why that number goes down, because the borrowing we saw in 19 and in 20 makes the current ratio not look as strong. And the final slide that I kind of put together is the debt service coverage ratio. You kind of can see that that boosted up quite a bit in the final year with some of the same factors we've been talking about.
So Marty, can you give our audience a brief overview in terms of requirements, sort of the easiest lender to the hardest lender?
Sure,
without
sure.
without casting aspersions on which
Yeah,
way to go.
I don't want to get in trouble with anybody, and I'll try
Right,
to
right, right.
I try to say something I think every one would agree with me on. Historically, RUS has provided the lowest interest rates. As being a subsidiary of the USDA, they're required to give out low interest loans. That's been their deal. But I think they'll be the first to admit too, with that lower interest rate comes a little bit more red tape. Some of the broadband funding, there was quarterly reporting that was needed. Annual reporting in addition to an audit, for sure having an audit done where other lenders may not require an audit. They require an audit, and they do require an annual financial statement that's put together in the way they want to see it too. So, and I think you go up the board. I mean, the lower interest rates sometimes going to have some more regulation, and so then if RUS is one level as far as a lower interest rate and maybe some more administrative duties related to it. On the opposite end of that spectrum is probably a local bank. A lot of times when I've sat down with clients at local banks, they say, "Yep, just give us financial statements annually. We don't care if they're audited. You can have a review done." We've got one bank that takes a compilation, and with the way the government support has worked for a lot of independent carriers, the regulators don't even let a compilation anymore. I mean, almost all of them are required to have a review with some sort of funding there. But I've even had banks, like I said, that didn't even get that uptight about that. So those are kind of the specters. But I'm also going to say, historically, when you've left the normal lenders in the industry, the RUSs, RTFCs, and co-banks, those local banks have historically had higher rates too. So less red tape, more handshake type deals.
Right.
But guess what? You're going to have probably a higher interest rate as well.
And what about the possibility of using equity funding?
We've seen some of it, Heather. We've seen some private equity come into the industry. Sometimes it's some family-owned companies, but when we've seen some of that money come into the industry, usually it's the same thing. They're not going to come in and give you 25% money for 25% ownership or 30% ownership. They want control. So if they're going to come in and put their money into it, they're going to want 51%. So then a lot of times that's been a backbreaker for a lot of our rural clients. They want to be locally owned. Right. They don't want to be owned by an investment capitalist in LA or New York. They want to own their company. So then when you get away from that, sure, we've had some companies that have decided to issue some of their own shares to raise some equity, explain what they're trying to do, say, hey, we need to get fiber to the home in all our rural areas. We don't have enough operating cash flow to do it. We're gonna issue some new shares to get some money to go into those areas. So they're issuing additional shares to current shareholders or shareholders in the community that want shares or have asked for shares. That we've seen that. We've also seen our municipalities that have issued bonds, and we've also had clients that have issued their own notes, saying, "Hey, we don't want to give you equity, but and we don't want to go to a bank. We'd like to give you a note for 4% or 5% and do a private equity." And some private equities would be willing to do something like that. Normally they want ownership, but you might be able to run some of them that would take a note if it's going to get paid back quickly and there's a good interest rate. So then you're weighing that too.
Yeah.
If you can borrow it at 5%, you really want to give someone a note at 4.95. You might just be better off borrowing too.
So we have talked primarily about bank debt of some kind. Even RUS in essence is like a bank debt. But you just briefly mentioned issuing bonds. Is that something that your clients have undertaken, or as a way, a revenue bond, or?
Our firm has had some, because we do work with some municipalities. I personally don't work with any municipalities that have done that, but I have worked with, I work with a lot with privately held companies and co-ops, and we've had a handful of those that have issued notes that have looked at other instead of going to a traditional lending institution, that have issued some notes for that. And once again, they're just trying to weigh what's a good interest rate. And to be honest with you, sometimes there's a relationship. It's a related party that's willing to do something like that, and to avoid the company having to go borrow or give them an interest rate just a little bit below going to a local bank, because they feel comfortable and they understand that entity's business.
Okay. I mean, the strategic decisions that you have to make are just unbelievable. So what kind of steps, given all the money that's going to be flooding the market, and I'm sure granting organizations are going to ask for a certain level of financial scrutiny as well for these entities. So what kind of steps should companies be taking today to get ready for both grant money and debt money?
Sure, sure. One of the first thing I do is all those covenants I just pulled up on screen. I'd go and calculate them right now. Know where you stand currently on those financial indicators that a lot of lending institutions are going to want to look at. If you're not in compliance right now, you're probably not going to be in compliance once you borrow money. So make sure that you can pass all those current financial indicators as you stand today before the funds come in. The next thing I would look at when I look at my books is there any other long-term liabilities on the books? Meaning, do you currently have a note payable to somebody? Do you currently have some long-term payable to somebody? Get those paid off. Um, you know, it goes back to what's the best way to borrow money? Have a lot of cash. What's the next best way to borrow money? Don't have a lot of long-term liabilities. The less long-term liabilities on the books, the best. So, looking at paying off some of those things if you can, just to clean up your balance sheet so you have no other long-term liabilities laying out there. Another thing I'd say, going from the liability side of the balance sheet to the asset side. When you look at your assets, do you have any assets that could be overvalued? And I'll get that question. What do you mean overvalued, Marty? Have you made an acquisition in the past? You have a bunch of goodwill or a bunch of intangibles on your books that may not be worth what's sitting on the asset side right now. Inventory comes to mind. Do you have a lot of, and this is specific when clients make the switch from copper to fiber, Heather. I've got a lot of companies that still have copper on the books, right? I know there's some value to that copper for you while you still have copper plan. Once you're 100% fiber plan, that copper is only good to somebody else. And if you still have it sitting on your books of what you paid for it, you may or may not get, especially.
Now, I understand, Marty, there are some copper thieves out there who think copper is quite valuable. So
Yeah.
you may be able to sell it in some third world country at a premium.
You're exactly right. Because what I've told people is once they become 100% fiber, I'm not telling them they got to take their copper to zero. But I tell them, I'll give you a year or two to try to sell that copper. If I keep coming back and it's sitting there, at some point you got to devalue it. And the reason I bring that up with when you mention this is what you don't want with all those types of items is you don't want to have to write that off once you have the debt. You want to get your balance sheet as clean as possible. Your assets, what you have as assets on the books are about that value or close to that value, which you could get for them. And then you don't have all these other long-term liabilities. So the long and short of it is clean up your balance sheet the best you can prior to borrowing.
And so finally, Marty, in closing, my question to you is when should a company be bringing in their accountant to assist with this effort?
Well, probably as soon as the decision is made to borrow. I know myself, other CPA firms, we help vet lenders. We help, we run projections based on different borrowing that may be needed at different interest rates. We look at, hey, can you meet these covenants that's in your debt agreements? We want to make sure that you don't get into something we know that you're not going to be able to justify and do. So I have some companies let me know right away and say, hey, talk through some of the things we've talked through today, and let me know when you need additional help. But the worst thing we want or what we don't have happen is if someone borrows at 4%, where we know an institution that would have lent you at 3%, and getting us involved with our networks as well as running some of the numbers as soon as the decision is made to borrow is a good idea.
Well, thank you so much for being with us today, Marty, and with sharing your expertise. And I think we're going to have more and more companies struggling with these kind of questions, especially as the ARPA money gets rolled out and then the next tranche becomes available through the Investment and Infrastructure Act. So I think everyone should be thinking about working with their accountant as a strategic partner and getting in shape so you can both apply and then take advantage of any supplemental funds you might need to borrow in the market. We plan to show this interview early in January, so please come back to our website at several times so you can see when it'll be available. We will also be marketing it through our social media, particularly on LinkedIn, so please watch for that. And with that, we will wrap up this edition of the Broadband Bunch Zero Touch Learning Series, and I hope to see you all next time. Thanks, Marty.
Thank you.